Welcome back to the Real Estate Social Club podcast, where we bring experts to have conversations. We've got a special guest here from Dallas, Texas, Stephen Nelson. He's a partner at Mills Wealth Advisors. Thank you so much for, coming to have a conversation about financial planning.
Yeah, thanks for having me. I'm looking forward to talking.
Awesome. Yeah, I'd love to, kind of dive in and talk about what you do and your background. I'm Maylai Tracy, the podcast host here, and I'll be bringing some tips and advice for mortgages and how it kind of ties into the financial portfolio of individuals. So happy to have you here today. I appreciate your time. So let's dive right in. Hey, Stephen, thanks so much for having a conversation. Tell me a little bit about yourself, your background, your experience.
Yeah, well, I think for me, the first thing, I'm married. I have 4 kids, and I love being a dad first and foremost. I coach my kids. Right now, I got 2 playing baseball. I got a 5-year-old and 8-year-old playing baseball. We got 2 boys, 2 girls. So that's what I love doing. And I love being a financial advisor. I've been doing it now for 13 years. I started at another firm originally in Utah, and about 7 years ago, there was a change in the Department of Labor wanted everyone to become a fiduciary. The firm I was at didn't want us to be a fiduciary, and I was a CFP, I was a fiduciary, and I was kind of like, oh, well, I probably shouldn't be here then if I want to be a fiduciary and you don't really want us to be fiduciary. So I ended up moving down here to Dallas to work with Mike at Mills Wealth Advisors, and I'm now a partner here. But moved here because I felt like it was the best opportunity for me to do what was in my client's best interest and allow me to just find what they need and help them achieve their goals.
That's amazing. I love that. Congrats about being a father, and you said you had 4 kids. That's amazing. And you mentioned coach. You coach your kids. Is baseball
Yeah.
your sport?
Yeah, I played college baseball. So I was a second baseman and played college baseball. I played high school football and basketball. So I coach my kids. I coach basketball when they play basketball. I coach football when they play flag football. But just, anytime I can be on the field with my kids is a good time. So I try and always coach them as much as I can.
I love that. I love that. I also grew up playing a lot of sports. I played basketball, softball, tennis, and I found it gave me a really strong foundation. Having been in sports and being in a team and being coached, it really does teach you fundamentals and life lessons that you can use later. So I love that about you. I didn't know that you are a coach and you played a lot of sports.
Yeah, I'm a huge Atlanta Braves fan. A lot of people are like, the Braves, you're from Utah. At the time they played on TBS, and so I could watch every Braves game, and so I just happened to love the Braves because that's who I could watch play baseball every day.
No, it's awesome. I love baseball too. I was actually pitcher for softball in high school, and I'm actually a big Dodgers fan. I love
Thanks. That's a good
Otani.
time to be a
I
Dodgers
love
fan
Mookie
right now.
Betts. Oh yeah, I love them. It's a great club, and they've got some solid players. They've got a huge roster, right? The very
Yeah.
expensive roster,
Yeah.
so they better
Very
do good.
expensive.
Right. Cool. So, all right. So, Stephen, when I think about finances and, you know, growing up in high school and whatnot, I really did not learn much in high school. There was no curriculum at, when in my schools growing up in the 90s. Uh, but, I really do wish that there was, because it was such a challenge, not having the ability to know how to budget, save, invest. These are such important tools, for living, right? Like you need to know how to make money, spend money, and how to help grow your wealth.
Yeah.
But unfortunately, I didn't learn a lot of that. But, when I try to think of how I learned, to, you know, Stephen, just it's just kind of one of those things. For some reason, it's innate for myself because I can think of saving. I was also always a saver, and I didn't understand why. I did remember like grandma and grandpa kind of telling me, you gotta, try to make money and save it, but it was very briefly. It didn't tell me like exactly what I needed to do, but I do remember being able to save money in like middle school. And it's always been something that I've done. I just like to save a little, just naturally. So I guess tell me about your experience and, what do you think about us as a society not, educating our youth, What are your thoughts on that?
Yeah, it's sad because most people, their like financial philosophy comes from their parents' opinion. It doesn't come from something they learn in school or necessarily even facts. Like most people, they have like baggage around money, like, oh, it's taboo, I can't talk about money. And other people grew up in a family where they talked about money, and so they did talk about it. But your parents didn't have an opinion on Pythagorean theorem, like it's factual. You have a teacher at school teaching it to you. But when it comes to
Mhm.
finance, most people are held back because they got bad advice from a parent or they got bad advice from someone else, as opposed to, in school, they teach you this is geography, this is history. They don't teach you this is finance, right? And so, like, it's almost like everyone is starting at different places. Imagine, you and I went to run a 100-yard dash, but you started at the 50-yard line, and I started at the 0-yard line, and we're running to the end zone. Like, you're ahead of me because you got better advice and better knowledge from your parents, and me, I didn't get that from my parents, and I didn't get it from school, so I got to figure it out on my own. And so that's the frustration that I find. And so, we kind of have to figure it out on our own. It's, finding books online, or, some kids, they just get into finance. I know the high school around here, they have like an entrepreneur club for the high school students, and where they're learning. And it's like, I didn't know anything about entrepreneurial anything until I got to college. And so these kids have a leg up on other kids. And so that's the thing I think that's really a problem with like finance and school, is that it's not a level playing field when you start out. And then obviously, there's a ton of people who they figured it out once they got older, but not everybody figures it out. And so it kind of sucks that, we don't teach very well finance in school. We don't teach accounting, right? Everybody's got to pay taxes, but you don't learn that in school.
Mm-hmm. Absolutely. I really hope that we can see that more in the curriculum at a younger age because it's so important. And finance is everything, right? There's a lot of emotional attachment to finances. It makes and breaks your life experience a little bit, right? Even with mortgages and buying homes, same deal, right? You
Yeah.
learn what you learn from your household, from your family, whatever that might look like, right? I'm doing, part of this podcast. I'm also going to the streets. I'm asking people, hey, like, do you rent? Do you own? And, this is kind of a segment that I wanted to do some research. I wanted to learn where people are learning about about real estate, what their knowledge of real estate is, whether if it's renting or owning, and kind of walking through their experiences because yeah, it all kind of points back to, oh yeah, my mom and dad, or my aunt, or whatever that looks like, taught me about this. That's why I decided to purchase. Showing the ropes, exactly what you're saying. You get this knowledge and you start at a different starting point, right? Kind of going back to learning, where do you recommend individuals to learn about finance? If they're listening to this podcast, do you have any spots to recommend?
Yeah, I don't agree with everything that Dave Ramsey says, but I think for someone starting out, Dave Ramsey, he doesn't give bad advice. It's all good advice, but it's not, I would say, the best advice always. There's certain things he says that I don't agree with, but I think for the most part, he's a great resource. Any of his books or his podcasts. One of my favorite books is "I'll Teach You to Be Rich." That one does a good job of starting early. It's not like, hey, do you have $1 million? I'm going to teach you. It's like, hey, here's what a credit card is. Here's what this is. And then we're actually at our firm. This is something we're focusing on because we have clients that are starting to have kids that are in high school that are having some of these questions, and so we've actually started to put out some information on our website around, hey, here's how a credit card works. Here's how insurance works. We got clients, kids who are graduating college and they're going to have to go get insurance. They're like, hey, what's a deductible? What's, out of pocket max? And so that's something that we're starting to do is like, hey, we see that our clients have these questions, our clients' kids have these questions. Let's put it on our website. And so we're doing a good job on our blog of trying to put out not just, hey, here's information. If you've got $1 million, it's like, hey, if you're just starting out, here's some information for you to understand.
Love that. I love that. That's so essential and it brings so much value to these families. Education is so important. It's one of the things that I believe everyone should always continue learning, because, education is super essential, right? Like having that knowledge and background will only help you in your life. And, I don't mean to segue, but I kind of want to, AI, for example, right? AI is unbelievable. It reminds me of the time when, computers, just kind of arrived and the web arrived. It feels almost that important, and that milestone, it's something that I can't even compare to, but we need to, adapt and be able to learn AI and utilize it in our businesses, even in our personal lives. It's very important. Some people hate it, but I also believe if you don't adapt, you're gonna get replaced. And it's not about AI replacing us. Yes, there is some. It's unbelievable what these LLMs can do, and that is a little scary. But I think, in my life, in my personal life, I'm trying to use that in my project management world, in my mortgage business. Are you using it yourself?
Yeah. It's funny. I actually just put out one of my like short videos was around this, and we're getting to the point where everyone has access to the same things. We've all got access to the same platforms, the same information, and I feel like just what you said, like with AI, like it's not necessarily going to replace us, but the people who can use AI to the best of their abilities are the people that are gonna rise. They're gonna become the cream of the crop. And so we've incorporated it into the way that we do our financial planning. So like we have this software called FP Alpha where I will put a tax return into this software and it'll go through and it'll spit out the important information. So I can sit down with a client and I could say, hey, you were in the 37% tax bracket. Your average tax is 23.5%. And it's not something I went and actually found myself. It's just AI went through their tax return and figured out that information. We're also using, Chat GPT on our blog posts. And we're like, hey, this is the blog I wrote. I'm not going and saying, hey, write a blog for me, but I write a blog and I'll say, hey, can you help me make this
Mm-hmm.
have better SEO reach? And it'll give me some suggestions of how I can have it have better SEO reach. And so we're doing things like that where it's like it's part manual, part AI, where we're using AI to help expand what we're doing. We're not just relying on it because when you start just relying on it, your brain isn't going to grow and become as valuable. But if you do the manual labor, then you say, hey, I did 90%, help me get that 10%. I think that's where you're really going to see growth potentially.
Absolutely. And, using those AI agents and platforms to help you, right? To complement what you're doing. You are your specialist in your field, right? So we need to be able to monitor what goes into that, right? So prompts, right? How we're writing those, but also, double checking like the information there because it's not always accurate, but sometimes even what I do between different platforms, I let them battle. I battle them. I'm like, okay, so I got in one tab Claude, I got another ChatGPT, and I'll say, hey, ChatGPT did this way better than you, and it actually spits out better results. It's really fun. So I kind of let them battle a little, and I just kind of laugh, and I'm like, okay, so this is it. You'll see it. I recommend to give it a try.
Yeah, I've not done that before, but that does sound like a good choice. I have. There's many times where I've had it do something. I'm like, "You're wrong. Like that's not
Right.
true." And I'll go pull the website, and I'm like, "You said this, and this is the truth." So you
Mhm.
definitely have to fact check it. But I have not tried pairing them against each other and saying, "Hey, Claude, this is what ChatGPT said," and "Hey, ChatGPT, this is what Claude said." Like that sounds fun more than anything.
It's a battle, and it's a challenge, and at the end of the day, I just want to get better, good, solid results, right, from those prompts. And interesting, you did speak about how you're utilizing it for financial planning. uh, when you send into ChatGPT or whatnot, what are you doing to protect the information there? I ask because I'm so curious about that part too.
Yeah, so I mean, on the Chat GPT side, we don't put any pertinent client information in there, mostly because I don't trust it. On the FP Alpha side, they're on the background. They have their own what's the right word?
Oh,
Encryptions and things like that. So
is that a specific AI tool for
So
financial planning?
FP Alpha is it's a software specific for financial advisors. So they'll look at like
Oh
tax
yeah.
returns, they'll analyze your insurance, they'll analyze an estate document. They'll look
Mm-hmm.
at all of those, and so they have their own AI in the back end that they're using, and
Mm-hmm.
they've assured us that client information is all safe, and theirs is it's siloed. Like my information is not going to be used for someone else. And, that's some of the stuff they've put in our contract. And so I'm not using Chat GPT necessarily. I'm just using someone else who's using AI. So FP Alpha, they're a company that we pay money to for them to do that for us.
No, absolutely. And there's big businesses in AI specializing in those industries, right?
Yeah.
Finance,
Hmm.
Medicare, sorry, finance, healthcare, law, right? So all of
Yeah.
those industries, very important to protect the information, right? Uh, cool. So let me go to the next section. Now that was good. I kind of like that. I,
Yeah.
I was thinking
Yeah, I like
about
that.
wanting to put AI in every of my episode because I want to see how people are using it or not using it. So kind
Yeah.
of a little research. Some people don't, and that's okay. But there's nothing wrong with it. It was just out of curiosity. Um, Cool. Okay, so the second part says building a solid foundation. Is there anything? So here kind of talks about, budget 101. You could blah, 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 emergency fund, building credit, retirement. So I guess I can talk a little bit about that and you'll just flow. How's that sound?
Yeah. That sounds great.
Okay. All right. So now talking about, individuals trying to build a solid foundation, what are some suggestions or key areas where they should start focusing on, to build wealth, and where does someone start? It's a lot of information, and a lot of people are lost. I ain't gonna lie. Some people are like, this is, especially if they have no background, right? What do you recommend them to do?
Yeah, as a great question. I can tell you as a financial advisor, when we meet with a client, the number one thing that we do is we look at their like cash flow, money in, money out. So budget. Everybody hates talking about a budget. And luckily now in where we're at, like you can get an app that's going to help you kind of create your own budget and see what you're spending. So like I use a company called Monarch Money where I've linked all of my bank accounts, all of my credit cards to it. And at the end of each month, it tells me how much I spent. So like I'm not going and creating the budget, it's telling it for me. And so the first thing I would always tell anyone is you have to know how much is coming in and how much is going out. If you don't know those two things, there's nothing you can do. You could create the greatest plan in the world, but if you don't know how much can actually go into that plan, like there's nothing you can do. So the first thing is figuring out what you're spending, how much is coming in, what's that difference, what's the leftover cash flow that you actually have to start to build wealth.
Hmm.
That's the first thing. And then once you've been able to do that, now you can start talking about, all these other ways to build wealth. But you can't build wealth if you're making the same amount of whatever you're spending. I mean, even
Right,
if you run a business, you still can't. Like, no business is going to grow if you're spending the amount you're making. Like, you have to
right.
have a profit, because if you ever want to sell it, someone's going to buy the profit. I mean, people buy businesses to buy the profit, because revenue, if the expenses are the same, I mean, it comes out to be zero. So in a family, you got to make sure that you have a profit that you can save. A business, you have to have a profit that you can save or sell.
No, that's great. I love that. That's a great tip and advice for someone starting out, and that's one of the basics, right? And even so, it could be in any you know income bracket too, right? You could be making over like 200,000 a year, and you could be spending all of that, which is very fascinating, right? Because you would think, right, like, or at a younger age, you think, oh, well, that person's making a lot of money, they're probably doing well. But you
Hmm.
don't know how they're spending it. Because if you see them spending it, they could be, in the zero. They could be in the negatives. They could be, credit card debt pretty high and just, So I understand what you mean about that. It's important for people to see how they're making money, like what they're making and what comes in, what comes out.
I
What
mean,
else?
to
What
to your
else
point,
was that?
I would say to your point, I met with a client just yesterday who, well, I guess it's a prospect who's going to become a client. I'm gonna start that over. To your
Sure.
point, I met with a prospect yesterday who makes 1.5 million. They made 1.5 million in 2024. From what we can tell, all they saved was 23,000 into their 401k. So they made all this money and they spent all this money. So most people think, oh yeah, only people who don't make a lot of money need a budget. And I'm here to tell you that I think everybody needs somewhat of a budget. And I think the
Hmm.
best way to actually do it is to figure out kind of a roundabout number of what your budget is, and then create a savings goal and just save first and spend second, because most people, they spend what's in their bank account. Like, I do it myself. I'll pull up my bank account, like, hey, do I have money? I'll go buy this thing I don't actually need.
Hmm.
And so if you save first into another account, you'll spend less just because you don't have the money to spend. And so this client, like this client that's going to work with us, like, we're basically going to build a savings goal for him. And like, first day of the month, we're going to pull that money out of his bank account, move it over to an investment account. And now he's going to spend less because he knows he's spending more than he needs to. And so rather than going like create an actual budget, we're like, hey, let's figure out how much you got to save. And I don't care if you burn the rest of the money, but as long as you save this amount,
Hmm.
save 100,000 for him or whatever the number is. As long as you save that, you can burn the rest of the money. I don't care. And so I found that's the easiest way to really budget, is save first, spend second. And some people can't do that because their numbers are so close, but most people, they can save first, spend second, because they're mostly just spending what's in their bank account. They're not actually spending on things they have to spend on.
Great technique, great strategy, and that doesn't surprise me hearing that. It could be, it sounds shocking, right? You're like, what? How can that, person spend that much? It happens, and it happens more often than we think. Especially you and I being in the seats that we sit at, we see what people, what comes in, what goes out, right?
Hmm.
But Oh, great technique. And what about emergency funds? Is that a good thing, especially kind of what's happening, in the economy? Even I'm seeing friends of mine, colleagues. Some of them are having a hard time keeping their job, and secondly, finding a new one. I see their LinkedIn banner, looking for a job, right? Looking for a position, and that's tough. Having emergency fund, what is the importance of that, and what do you recommend people to do?
Yeah, I think an emergency fund is like the base of a financial plan. I can tell from like personal experience, when I was in college, my freshman year of college, my dad was let go from the firm he was at. And, me, I was super worried about it. And my dad's like, don't worry, we've saved. we're okay. We've got enough money for me to find another job. And so, like, I saw personally my family go through it. And because my
Mm-hmm.
parents did that, they had an emergency fund, they had saved. My dad was able to take some time, find the right next job. So, we recommend that depending on your job, depending on your stability, have, 3 to 12 months of an emergency fund, because you don't know how long it's going to take. Back in 2008, it took people a year to find another job because that was a big recession that happened. It's not always going to be that way, but having somewhere between 3 and 12 months, and the more stable your job is, you could probably have a little bit less an emergency fund. But like
Mm-hmm.
emergency fund, if someone comes to me and they say, "Hey, Steven, I want to invest money with you," my first question is, "Do you have an emergency fund?" Because if the answer is no, and I go help them invest and then they lose their job, they're going to want to take the money that we've invested. And I don't know if the market's going to be up or down that day. And so
Mm-hmm.
I can't, invest their money if they don't have an emergency fund because I don't have any guarantees that they won't need that money tomorrow. But if they have an emergency fund, I at least know, well, they probably won't need this money for 3 to 6 months. And usually that's enough time for the market to go up or down. And so we always say, if someone comes in and say, "Hey, I want to invest with you," we're like, "Okay, do you have an emergency fund?" If the answer is no, we help them build an emergency fund and then we'll invest the money.
I love that. That's super important. And 3 months to a year. And I think it's hard, right? It's hard. People, it's emotional. People and their money, it's
Hmm.
emotional. People spend very differently as well. I have to say, like, I know so in my circle, we all spend very differently. And I say that because it can be it could be a challenge if you're with, you have a partner or whatnot, and you spend very differently, right? People can blow through emergency funds pretty quickly. Um, I really do think it is important to have an emergency fund. I agree with you 100%. And now let's talk about credit. What about credit
Hmm.
for individuals? How do you feel about that? And what's the importance of having good credit?
Yeah. So this is the main reason why earlier I kind of put a caveat on Dave Ramsey, because he's like totally against credit
Okay.
and I am totally for credit.
Hmm.
The first trick that I would tell someone is, when you have a kid who's responsible and they're, high school, college age, you can put them as an authorized user on your oldest credit card and not even give them the card. And then that now helps their credit. So technically, my oldest credit is older than me. My parents, when I was in college, put me as an authorized user on one of their credit cards, and I still am. I don't even have access to the card anymore, but I'm still on their credit card as an authorized user, and it's actually a year older than me. And so that's a trick that I tell people all the time, is like, hey, if you have a responsible kid that isn't going to go and try and find a way to overspend, and there's other ways where you can like minimize how much they can actually spend on per their card. But as far as like, an idea would be putting your kids as an authorized user on one of your cards, because
Mm,
that helps build their credit. So when the credit bureaus look at me, they're like, "Oh wow, Steven has this big long credit, and it's like actually older than I am." And so I'm grateful my parents did that, because that helped me build my credit score early. But that's, I think, the first thing that's kind of like an easy layup for parents. If you have a good kid that you trust, you can make them an
great.
authorized user, not even tell them, don't give them the card, but now you've helped build their credit. But the other thing is, building credit is important because it shows people that you are worthy of lending to. And when you're buying a house, that's super important. It can be the difference between you getting a house and not getting a house. So
Mm-hmm.
obviously, back to budgeting, if you have a good budget and you pay your credit cards on time, that is going to be, the credit bureau is going to look and say, "Oh, wow, Steven pays his credit on time. We're going to give him a little bit higher credit rating." So like those are things that like it all comes together. If you have a good budget, you make good decisions, you don't have too high, you don't spend too much on your credit card because you have a budget and because you're not spending. All of these things kind of go together, and it allows someone to be able to, when they want to, get a bigger house than maybe somebody else could. Because of my higher credit, I might be able to get a better house than someone else who has lower credit. And it's just because the bank is like, I will lend Stephen more than I will Sean because Stephen
Mm-hmm.
has proven that he's more credit worthy. And it really comes back to a budget, like making sure that you're not spending too much on your cards, making sure that you're paying them back on time. And
Mm-hmm.
in doing that, that's really going to be a huge help. So it comes back to a budget, comes back to a good financial plan.
Absolutely. And this all gets me very excited, and it ties back to real estate. You took the words right out of my mouth. Having good credit, you're going to get better mortgage rates, right? People look at rates all the time. They're like looking and seeing. I'm like, what you see out there doesn't mean you'll get that. You need
Exactly.
to go through the application. We need to see who you are. We need to see a financial picture of you as a potential borrower to look at what your credit is, to look at your savings, how much reserves you got in there, right? Lenders need to see this information to determine A, if you're worthy to lend to, B, if what kind of rate you'll get, right? And it all ties in. It's hand in hand, and that's why I invited you here, because I know it's super important. As I started this real estate social club, super important to have a financial planner to come talk about these things, because it all ties in. It all ties in, and I'm really excited you're here, enjoying the conversation so far. I hope the audience is as well. I also want to dive into the investment side, right? Retirement planning at different age, right? Like a different, sorry, retirement planning at different decades. If someone started later in their life, 40s, whatnot, what they can do. So I'd love to kind of break it down with you, to kind of give people in different decades, in their 20s, 30s, 40s, or even 50s, what they could start doing. So let me just roll my little my script. Okay. Okay. How does that sound? So I'm gonna just
Yeah,
ask you a
that sounds
question, and
great.
then you could start to flow with each of those decades.
Perfect.
Kind of looking at kind of looking at retirement planning. What are your strategies depending on what stage of life people are in?
It's funny. I think that we may cut a little bit different than other advisors on some of these. So for younger people, let's say someone has a job and there's a 401k, I'll recommend that they at least do the match. If the company's matching 3%, you should put in 3% to get that match. There's other advisors that'll say, oh no, you need to max out your 401k as early as you can. I've been doing this long enough to see that plans always change. So you might have this young kid that's plowing a bunch of money into a 401k, and then later in life he's like, man, I wish I could have access to that 401k money because I have this opportunity. I want to go buy this rental property. And I
Mm-hmm.
believe that buying rental properties or buying real estate inside of like retirement accounts, like you'll see people all the time online like, use your IRA to buy real estate. And I think that's a bad decision, because one of the best things about real estate is the depreciation you get, and you don't get any of that inside of an IRA. And so like we tell people like, hey, when you're young in your 20s, do the minimum of whatever the company matches. And then on top of that, you should save into like a Roth IRA or just a taxable account. And the Roth IRA is cool because you can access whatever you put in tax free, penalty free at any point. So let's say over a 10-year period, I put $10,000 into a Roth IRA. It's grown to 20,000. That first 10,000 I put in, I can pull out tax free, penalty free. And if I'm buying my first house, I can actually use that other amount, the gain, as a down payment. I have to pay taxes on the gain, but I don't pay a penalty. Roth is kind of like the second place we tell people to spend, because it's partially liquid. And then if you're buying a first house, you can actually access some of it. But the taxable account, it just creates flexibility. I can't tell you the number of clients that I meet with. They're like, hey, we'd love to buy a rental property. And then we look at their stuff, like all your money is in a 401k. Like you're not going to go buy a rental property with that, because it's not, it's going to defeat the purpose. And so
Mm-hmm.
early on, we tell people, yes, save, save, save. A dollar saved at age 20 is worth 40 by the time you're 60. So like, yes, save, But I don't think that when you're young, you need to save it into your 401k, because later in life, you're going to kind of have some opportunity come up and you're going to say, man, I wish that money wasn't in my 401k. I wish it was just in a
Uh-huh.
regular investment. And so that's kind of how we tell people to start. It's like 401k match, then do the Roth, and then anything else go into a taxable account, because you want options. When you get older, you want options, I promise you.
Oh, that's great. That's great advice. And would you say that in your 20s, would you apply
20s
that
to early
strategy?
20s to early 30s, I would say. I would say being more, you know, more I would say being more flexible is important the younger you are. Then when you get in your 30s and 40s, now, you hopefully have built up some of that taxable money where it's liquid. Now you can start putting more into your 401k. And let's say your income is higher. Now you're in the 24, the 32% bracket. Now putting money into a 401k is actually going to get you a real deduction. And so the older you get, the more I see the value in putting money into a retirement account, especially tax deductible, like the 401k. The younger you are, the more I like Roth. And then once you're in your 40s, 50s, and 60s, I think at that point you're safe to put money into a 401k, because let's say you're 45, you can start pulling money out of your 401k by the time you're 59 and a half. So if you're 45, you've got 15 years until you need it. Now, if you put that money in there when you're 20, we're talking about 30 years before you can touch it. A lot can happen over that time frame. So the older someone gets, the more I'm comfortable them putting into their 401k, because 401k means it's kind of locked up from you to use it for most things. So
And
the
it's
older
kind of
you get,
close, right?
yeah.
It sounds like the time period is a little closer, right? If you're in your 40s and you can pull that out at 59, uh, yeah, I think that's a good idea. Any other key strategies in your 40s, you know?
Yeah, I think, in your 40s at that point, now you should have more diversified assets.
What if they don't? What if they don't?
What if they don't? Yeah, I mean, if you
Right.
don't, like at that point, like that guy I met with that's making like 1.5 million hasn't saved. He's in his 40s, and so if you're at that point, like you're definitely gonna want to get whatever 401k matches out there, because that's free money. But then you're gonna want to do more, because if you make good income, the more you save, the lower you're gonna pay in taxes. So it behooves you to save more. So someone who's in their 40s and just starting out, I think the first thing you got to do is figure out what your budget is, see where
Mm-hmm.
you can tighten your belt, and then figure out how much you need to save and just work towards that. Um, and then same thing in your 50s, 60s. Using real estate, I think, is a great thing. I can't tell you the number of times that someone comes in and we start talking about real estate, and they're like, "Wait, I thought you were a financial advisor." And I'm like, yeah, we love real estate. Like my partner owns the building that our office is in.
Mm.
We really enjoy real estate. I believe that a portfolio that is a third in real estate, a third in equities, and then like a third in like safer assets is the best portfolio you can have, because it's going to be the one that performs in every single time period, and it's going to provide you flexibility. So for us, you have somebody who comes in who's 40 and we're like, hey, maybe you should look at having a rental property that's going to create, kind of that guaranteed income in retirement. People used to get pensions. Now we get 401ks. The pensions had guaranteed payouts. 401ks, they're more variable. When you go
Uh-huh.
buy a real estate property, it's got that income that should come in as long as you have tenants. So we'll tell people, in their 40s, like, hey, you should save some into your 401k, but then you should probably start carving off some money for a down payment on a rental property that hopefully will be
Hmm.
paid off by the time, if you're 45, you could probably have it paid off by the time you're 65 and retire. And now you've got some guaranteed income to go along with the investments that we're helping them with.
No, I love it. I love it. I love talking about this. Gets me super pumped. No, that's great advice.
I'm the grandson and son of real estate agents, and so I'm probably one of the most like real estate friendly financial advisors there is out there. My grandpa's 90 and he's still selling houses, and so real estate's always been something to what we do. Yeah,
Wow, I didn't know that. Grandpa's
yeah,
cool.
yeah.
What's Grandpa's name? I'm gonna go and research him after.
Fred Schaefer. You can go to one of my recent LinkedIn posts, and he liked. I think he liked one of them recently. But yeah, Fred Schaefer. He's in St. George. He's been in the real estate game for a long time. He was in like the Salt Lake area and moved to Vegas for a while, and now he's in St. George. But I mean, I think he'll probably do maybe five. I think he did 10 transactions a couple years ago. He might do 5 to 10 this year. And then my
Wow.
mom's a real estate agent. My brother is actually a real estate developer. So like, there's a lot of real estate in my family, and it's something I've always seen value in. And so, as a financial advisor, we kind of use that and we say, hey, there's some value in real estate, but the people I talk to who only have real estate, like sometimes they want some liquidity. So having a little bit of both is a really important thing, I think.
Yeah, I believe so too as well. Just to diversify and have that ability to shift when you need to. I think that's
Exactly.
super smart. Awesome. Okay, so let me scroll to the next section. Okay, so section is investments beyond real estate. So people talking about stocks, bonds, mutual funds, EFTs, and REITs. So, okay,
Yep.
so I'll ask you and you can do your thing.
Okay. Perfect.
All right, so let's talk about investments beyond real estate. People hear about stocks, bonds, mutual funds, ETFs, and REITs. It all could be very overwhelming. So, what
Hmm.
should they know?
Yeah, I think my personal belief is when you're gonna go invest, I think investing diversified is the best way to go about it. If you're going to bet on like a stock, I'd rather you bet on yourself and go start a company because you can go bet on a stock. And I think a really great or bad example is like United Healthcare, where they had their CEO was shot and murdered back in December, and their stock has done really bad since then. And that's something that's completely out of an investor's hands.
Hmm.
So if you're going to go invest in one stock, make sure it's your stock. Make sure it's you. If you're
Mm,
going to go invest and not have any control, I think being diversified makes the most sense. So the way we look at it is we just say, hey, what are the options out there? And you can invest in the United States. You can invest in what we call developed countries outside of the United States. So like places like England, Germany, where they're very similar to us, but they're different. And then you have emerging markets, which is typically like the BRICS nations, where you got like Russia, China, Brazil, countries like that. We look at those and we say, okay, we should invest in all of these because they're diverse. They're going to go up when others go down. And then you have real estate, which has actually been one of the best things to invest in. So if you don't own any real estate properties, you don't have any of your properties on your own, we like to give clients a REIT, which is a real estate investment trust, which you have the opportunity now to own these real estate deals that
mhm,
someone else is kind of putting together for you. And whether you do a mutual fund or an ETF, they're very similar. They trade slightly different, but they're kind of the same thing. And then REITs, you could have a REIT that's an ETF or a mutual fund. And so I think on those, most people are using ETFs now because they're cheaper. So we use
mhm,
a lot of ETFs. But I think the way we look at it is we say, how aggressive do you want to be? On one side, you could be completely aggressive. On the other side, you could be completely safe. And most people fall somewhere in between there. And so we'll talk to them and we'll say, hey, how much risk do you want to take? And they're like, well, I don't want to take a lot of risk. We're like, okay, maybe we'll have you be 70% aggressive, 30% safe. We're going to cut off some of the losses. We're also going to cut off some of the gains, but you're going to fall into a more safe area. And that's what we help people with. And so if you're an investor, I think going and doing some research around those and figuring out what risk, I mean, there's a ton of online risk questionnaires that you could take. But I don't think most investors should just go buy a stock because I could go buy a stock and everything could look great. And then the next day the
mhm,
CEO gets shot and the stock goes down. Now that's not the only reason United Healthcare went down. I know that, but it was kind of a big piece of what happened. And so we believe being diversified, if one company goes down, you have another company that might go up. It's the old idea of if you own umbrellas and sunscreen, when it's rainy, you're going to sell the umbrellas. When it's sunny, you're going to sell the sunscreen. By being diverse, you kind of always will win. And so that's what we recommend most people do is go be diversified because the worst thing you could do is go buy one stock, have that stock go to zero, and now you lost your money. Or if you buy diversified, your money might lose a little bit of value like in 2008. But if you're
mhm.
diverse, even in 2008, it went down, but it's come back up since then. It's up like 250% since 2008. Like you, by buying diversified, are going to protect your long-term investment. Where if you buy one stock, it could go to zero and you lose it.
Oh yeah, that's very, very true. No, I think it's super insightful. People are going to definitely find value in this information. Now, if we were to speak about financial freedom and, everything that you've kind of spoken about, what are some key takeaways that you think individuals should, start to plan, as a vision of what they're wanting to do, and maybe some key things to do right now, short term?
Yeah, I mean, I think, if I were to list them out, it would be number one, figure out what your money coming in and going out is. Because if you don't know that, you can't really do anything. The second thing is start as soon as you can. I think Warren Buffett said the best time to buy is today. It would have been better to invest yesterday, but today's the best day to invest. So start early. If someone listening to this is 20 years old, start saving as much as you can, whether it's $50 a month, $50 a week, whatever it is. Start as soon as you can, because then you have that compound growth. And then I think the third thing that I would tell people is, if you're going to bet on something, bet on yourself. And if you're not, then go invest diversified. And there's a ton of stuff out there. Vanguard and Dimensional Funds are two of my favorite fund companies. Anything they put out, I think, is good information. So go read some of the stuff that they have. There's people you can follow on Instagram, Twitter, LinkedIn that are financial professionals, and just go listen to what they have to say. Like, I put out information on Instagram, YouTube, and LinkedIn every single day. And hopefully someone can come listen to that. And if they don't want to work with me specifically, but they want to do it on their own, hopefully they're going to learn enough from listening to me to go do it on their own. And so I would say just go start learning. Learn as much as you can. And then if you need to hire a professional like myself or someone else, do it. But if you want to do it on your own, there's enough information out there from reputable people that you can do it. But start today. Don't wait.
No, I love that. I love that. And when you say reputable people, so that's something that we kind of spoke to in our first conversation over the phone. How can they select the right person, right? Because there's a lot of content out there, and some might be garbage, right? Some might be leading you to a wrong path. What can someone do to verify that that person has the license, is experienced? What can they do to select the right person?
Yeah, it's a great question. The gold standard in like the financial planning world is the CFP, the Certified Financial Planner. To have that, you have to do continuing education. You have to like not do bad things. So like, if someone got in trouble for like a felony or they had a bankruptcy, like they could lose their CFP license. So I think like the first step is like, are they a CFP or not? Back to my initial story, I was a CFP working at a firm where they didn't want us to be a fiduciary, so I left. It was that
Hmm.
CFP that kind of drove me. So I think if you go and look for someone who they have that CFP or they had it, there are certain people that are online that they drop their CFP because they're only producing information now. They're not actually an advisor anymore. They're just producing information. So if you find someone who's like, hey, I was a CFP that had good standing, but I dropped it, and here's why, that's someone I think you could listen to because they at least at some point were the CFP. But I
Hmm.
think if they have it currently, that's the easiest bet. I mean, there's always going to be wolves in sheep's clothing. So I think if you go and you listen, you're like, hey, I listened to these five people, and one of them, he said something that was kind of crazy that the other four didn't say. Maybe you don't listen to that guy. But if you go listen to probably like four or five CFPs and all of them are saying about the same thing, you can feel pretty good in what they're saying.
No, that's great. That's great. That's going to be super helpful for individuals because there's a lot of content out there. Get a little lost.
Hmm.
So,
Exactly.
lastly, here's a question I like to end with. If you weren't doing what you're doing, what type of industry or role would you be doing?
I think I have two answers.
Okay.
One is I would be an attorney. I was actually studying to be an attorney. I was going to take the LSAT. I did an internship at a firm and fell in love with financial planning. So I was planning on being my whole life path was going to be an attorney. My mom said I was
Really?
really good at arguing, so she's like, "You should be an attorney." My great uncle was an attorney. My grandpa Fred, his brother was an attorney, and I was like, "I want to be an attorney." So I could see me being an attorney. And the second thing is I would probably be in real estate. Honestly, I mean, I'd probably go into do with my brother and do some developing, or work with my mom and my grandpa and be a real estate agent, or maybe even a loan officer and work with them. But I think I would either be in real estate or I would be an attorney.
Great, great. What kind of attorney?
I was going to be an estate planning attorney, kind of the same side, doing estate planning, helping people set up wills, trusts, all that stuff.
Awesome. Stephen, it's been great having you and talking all about financial planning. I think this is super helpful, and I've learned some things, and I know the audience will as well. For anyone looking for you, I'll drop your information on the bottom of this YouTube channel. And thanks, audience, for watching. Follow, hit subscribe, share this to anyone that you think would share this to anyone that you think would benefit from this information. Thanks so much, Stephen.
Thanks for having me. This was a blast.